Good afternoon, everybody. This is Jeff Scott, and welcome to this week's top-down review. It is, after 2 p.m. on Sunday, September 6th, and we have an extra day on the weekend this week, which is awesome. I called today failed breakouts, a shot across the bow, or a buying opportunity. That little R is not a mistake. I had a misnomer when I first wrote it. It said a short across the bow. And I think maybe the short's a good thing to have there. So I put parentheses around it and it popped up with a circle. So who knows, TradeStation, not our PowerPoint, not me. That's what it gave me. Interesting time in the market, to put it mildly. My name again is Jeffrey Scott, and my email address is hgsidoc@gmail.com if you have any questions or comments about what I show and talk about here. As always, this is for educational purposes only. I am a doctor, not a broker. I have no licenses or affiliations that could trade money for you or anyone else. I pay for the tools that I use, and nobody pays me for anything, whether it's for my videos or education. And trading involves risk, and you alone are solely responsible for any decisions you make. From time to time, I talk about options, and I refer you to the Options Industry Council, where you can get educated about the risk of options. Be your own guru. I've added, and I'll continue to add, folks whose stuff I use and who I think can make a difference. But before I even go through this, and I'm not going to spend much time on it, I've done it enough times, I had a little alert today that it's a certain Mr. Ian Woodward's birthday today. We lost Ian in 2016 in May. I believe he was born, I'm not going to guess. I'd probably flub it, but it's Ian's birthday, and I wish he was here. I owe so much to him, as do many of the others folks that I talk to. Great guy. My whole style of investing is find smart people, find good tools, get good at them, and become your own guru. These are some of the people I use. I just want to point out John Person, Sagar, and Dr. Keith, because I'll be working with them this on Monday in a live webinar, and I use each of their tools, and I'll be demoing how I use some of them today. On a desert isle, and if I had internet access and electricity, which is kind of a joke on a desert isle, if I had all those, I could probably get off. But I need TradeStation and Thinkorswim. I need HGSI and EdgeRater. And then I need John's indicators across the board, the Q tools and the Dr. K tools. Now, I've never done one of these, bring other speakers like in mass before. And I just want to remind everybody, I'm never paid by any vendor when you buy something that I suggest or use, and any affiliate fee offered to me is passed to the purchaser as a discount. I don't do this to make money. In fact, I'll lose money because I'm going to have to buy a larger room in Zoom just to do this. I'm an unpaid volunteer, and for me, this is just education. So here it is, HGSI Doc and Friends Labor Day special webinar, Monday, September 7th, tomorrow, 10 a.m. to 2 p.m. I'll be joined by those listed there, and there will be special offers, at least on HGSI, for new users. And if you don't see a link on the YouTube site or in the email that I sent out with this recording, it's tinyurl.com/HGSI-Doc Labor Day 2020. If you need to, stop the video. The website for HGSI, again, I have no financial affiliation, no voting, no leadership. I'm just a very happy user. And I've learned so much using this product. Free 30-day trial. Again, for my Labor Day special, there's going to be an additional discount offered by the company. And under investing strategies, you'll see thousands of videos by Ron Brown, myself, and others. Stock patterns are cyclical. Every stock, every index, every industry group, every sector goes through this pattern over and over again. I always like to think, where are we? And then use that to help guide my decision making. Well, the problem is, I would say that certain things, at least as far as this week went, some of the casinos, airplanes, cruise lines act like they're coming out of a base and going higher. I'm not saying I believe it. I think it's junk off the bottom. And then you got high cap tech that's rolling over. And then you have banks that are starting to stir. So for me, the NASDAQ, especially the high tech, it started to roll over and it's catching up to the others. They're holding up much better, at least the Dow and the Russell, thus far, as far as deterioration. Talk more about that. So since I'm becoming less convinced that we are in a strong trending go to the moon market, I've raised cash, smaller positions, sold premium. Now I've still got plenty of long on, but I've tried to mitigate that with some puts, buying contra ETFs, and some shorting of stock. I will tell you that I did some lotto options, which I'll talk about tomorrow at the end, where I probably had a 10-to-1 return, 100,000 on a $10,000 risk. So that's a pretty good return, especially when you look at the duration of being a week. I did them in VXX and UVXY, had some signals that they were going to spike. I think they're going to go higher, but those were 1 week options and covered. Friday sector report, these are all the S&P sectors, starting with the materials here. And the first thing that I noticed was, boy, healthcare looks awful. Utilities look awful. Technology looks awful. And then financials have a lot of green, as do materials. So maybe the market is starting to evolve. Even energy had some green in it. That would be market rotation. So I like to look at the actual indexes when I do this. So let me open up, make sure this is on daily. I made that mistake before. And very quickly, I mean, if you think today is going to be the day of me giving you 30 longs and buy, you're on the wrong channel, because it ain't happening. Why? Because I think there's still a question of where this market is going. So this is the S&P futures. I try and tell you when I'm using futures versus when I'm in the cash market. Why do I like futures? I like futures because it captures the entire 24 or almost 24-hour cycle and not just the hours that they're open in the U.S. And it fills in a lot of what might be gaps at other times. So the first thing that I notice is that, as we all know, the markets peaked around February 20th, and then we had just a horrible sell-off bottoming March 23rd, and then we've had an amazing run back up, and it's kind of a V. It's not a perfect V. There's a little small pullbacks as you'd expect, but that's a V bottom. And we've had modest pullbacks in June. We had little hiccups in May, a little hookup in March, and now we're seeing one in September. Now this looks a little worse to me. When I come back here, I look to the left. I don't see days like that until this initial reaction in end of March. And you have to question, is this we're rolling over, or is it a surprisingly bullish appearing pattern? And I think I can make multiple arguments here. The bearish argument is simple. We've had a long run. We failed, almost a bearish engulfing pattern at what would be a red candle high in a very extended market. And look at the volume on the down days. And this is not your third weekend of the month option expiration. So one could certainly argue for the bears. We'll show you divergences. We'll show you large caps starting to roll over. But on the other hand, one could look at this second candle for sure and say, well, look at it from a bullish perspective. A small pullback that, we're not talking major pullback here, all right? 4 or 5% is not the end of the day. It's something that you might expect to see, and it's got a bullish wick on the bottom. And it stopped right about on the 17-day simple moving average. So black or white, this is not a market. This is it's not an easy call. Part of me thinks this market's going down hard. We'll talk more about that later. But you could certainly argue that we got Labor Day week coming and we'll have a holiday rush. Volume will come back in and maybe we'll go test new highs before we fall. That would be awesome because it'll give us all a chance to get out of the longs we're stuck with. On the other hand, You also have to recognize that above here are a lot of people that bought in the last week, and they can't wait to get out because, oh my God, I was the last one in. So that's going to put pressure, I think, on keeping the market from going higher. Bullish and bearish opinions. The NASDAQ futures, high of the year, just like on the Dow, were this week. You could see it right here. Much more impressive than the S&P. Here was the prior highs. And all of these, the 17s above, the 50 above, in this case, an uptrending 200. And what do I have here besides a person sell signal, which we also had one hidden under here on the Dow futures? We have not quite a hammer, maybe too much body, but a tail, a bottoming tail that came almost down to the 50 and bounced. To me, same argument. This could be a reversal quickly, but I'm not sure, and I wouldn't necessarily trade what I think on Sunday, wait till Tuesday morning. If I look at the Dow, the story's similar, right on the 17-day. And look, the 17's above the 50s, above the 200. The Dow has made a big comeback as well, although it's certainly been a laggard on the year, has not taken out its prior highs yet, which is one difference. And then lastly, the Russell 2000. Not only has it not taken out its 2020 highs, I think the highs are in 2018 on this index, and it also pulled back and stopped on the 50. Now, that would be a place you'd expect it to stop. I think it remains to be seen. Now, I don't know what happened to my volume here, but not important right now. If we look at the daily VIX, you'll see what happened to my lotto options. Why did I buy these? Go back and play last week. I said I'm nibbling at some volatility. Why? Because I noticed that even on up days, the VIX was firming. And it was going up every day this week, even with Monday and Tuesday being strong days. I had some that were dated 1 week. I got out of those on Thursday. Glad I did. I had some that were dated to next week that I'm still in. Lotto options. I bought butterflies with what I call I don't know what a broken arrow, a broken wing butterfly is. Maybe what I'm describing is a broken wing. I never got that education. I just call it a butterfly that won't fly, where one wing's a whole different side than the other. And the way I design it is, even if it goes through the high price, I'll still make back more than what I paid for the butterfly. One of the problems with butterflies is you could be really right and the stock moves so much in the direction that you end up losing on the trade. But that's a different day. So the VIX came back some on Friday despite a weekday. Now, if you look at the 3-month VIX futures, they're significantly higher, which tells me that the VIX is anticipating going higher in the future, and which will probably cause this to continue going higher. But I'm just an amateur, so that's what I think. Listen to the real gurus who are going to be on the phone with me on Monday. Dollar firmed up some, not a big move up, but it certainly stopped going down. So that was my original take on the market. We're going to look at the market 17 different ways before we get done with this. On the weeklies, not a whole lot to add, except we were in great bull markets until March, or February, March. How about underneath? We had good economic, or at least employment numbers on Friday. Rates moved up on that. For the week, they were relatively flat. They're still super low. And even when you compare them back to 2007, 8, 9, low interest rates, they were too low. I think that the markets, I've always put this lower line here as above that and below the higher lines, the markets are happy. Rates too much, that's bad for the market. Rates too little often mean that there's economic challenges. AD lines, finally, we saw a breakdown a little bit in the large caps. The small caps have still not making their new highs. And in fact, if you look at the NYSE AD line, you could see we did not take out the prior high here, nor do we take the prior out high here. The big turn down here are the big boys, the diamonds, the Qs, and I believe transports are in there as well. Here's the IWM, which has been lagging. And notice what looped up a little bit this week. Despite the rates being okay, bonds moved up. Is this the time that Jeff Scott's going to start showing you a bond chart and maybe it's time? Been a long time. Breath weekends as large caps roll over. I should have moved this green arrow down, but this came down to here. So less stocks above the 200. This came down, stocks above the 40. When I see more stocks are above their 40 than they are above their 200, it just tells me that stocks are in a range between the 200-day moving average and their 40-day, and I like to buy stocks when they're above their 200. So we are not in a healthy market by any means. 3-month new high, new low. This is a great short-term sign of reversals. You can almost look at every time it spikes down and you'll see in yellow the S&P starts to go up. Well, we're nowhere close to spiking down. When we spike up, it turns down. So we're at a point now where there's no signal here. We're neutral. Daily and weekly McClellans, we've been talking about bearish divergences in the oscillator and the summation index over the last several weeks. We had zero line rejects, I believe, on both the daily and the weekly this weekend, or this Friday. Clearly, this gave us a warning of among the many signs that this market was going to correct. Now, we don't see anything that says it's done. We don't see any excessive, we don't see any bullish convergence, but this is early. And, I think we have more to go to the downside. For those that are new to me, EdgeRater is this awesome tool. I should have invited Chris to speak tomorrow too, but he's in London and I had to figure out what his time would be. But EdgeRater is this awesome program that takes data from its own data or other sources, and you can run analysis in minutes that would have taken hours in Excel. In this one, we took all the stocks in the S&P 1500, put their Bollinger Bands on them, and measured what percent of those stocks were above or below their Bollinger Bands. When 62% of the stocks are trading below their Bollinger Band, at least below the midline, let me say it better, below the midline of their Bollinger Bands, then you know you've got a market where most of the stocks are trending down or bearish. On the buckets, you have 10 deciles, 0 to 10, 10 to 20, 20 to 30% of the bandwidth between the Bollinger Bands. You've got one below and one above. And I look for reversals when this number might get to 80 or 90% of stocks below the midline, and 30, 40, 60, 80, 90% of the stocks are below the Bollinger Bands. I see this bearish, but not a signal. The Hindenburg Omen, something that was discovered many years ago that Ian Woodward, birthday boy, brought back to prominence. We see these after market tops, and they're early warning shots across the bow that the market's at risk of rolling over. We saw plenty before the market died in February. As you see, we see none right now. If we did, they'd be lighting up yes over here. Automated feature in EdgeRater. In EdgeRater, I can look at the U.S. markets and get a sense of the tone. Those that follow me know that a kahuna is a percent change greater than 24 or 40%. The bigger move is darker red, the smaller move is lighter red. And when I see them to the upside, they're blue. When they're to the downside, they're red. And they often trigger a change in direction of a stock or a market. When I see all the major indexes have a kahuna to the downside on Thursday, I am not surprised to start seeing some damage to the market. When everything is green, it's bull, it's happy, it's exciting. When things start turning red, the market's a challenge. This black and red on the right just shows the volatility that we saw in the market this year when the market fell over. This market's showing some evidence of damage. Sector strength also weakened, no surprise. We'll look bigger at that here. One thing that Sagar, I hope, will talk about on Monday will be his superior profit Q tools. Let me give you the spoiler. You have to get Metastock, Refinitiv, real-time data to do what I'm going to show you. It's really a shame because as a real-time tool, this is fantastic. Now, it may work with end-of-day data and give you the same picture, but I have this shot up running on one of my monitors all day long, every day, because I learned so much. So what do I see here? This is 2 different time frames, or 6 time frames, actually really 5 time frames because there's overlap. On the top In purple, I'm looking at performance in 1 day, blue 2 days, and in this reddish maroon color, 5-day performance. If I drop down here, I have the same 5-day performance, 10-day performance in green, and in the brighter blue, I've got monthly performance. So during the day, I'm able to see which sectors are leading. Then over here is a super powerful tool, and I thank Sagar. I don't know if I told him to do this. I know I'd asked for some of this, and he did it. Look at how cool this is, that I know that during the day, 56% of the stocks were bearish, 62% of the industries were bearish, 55% of the sectors were bearish. This is 2-day performance and 5. Why is that important? Because bet your golly, if you see a market where the indexes are up and you start noticing that the pie red starts to grow, then you know that index is coming back. And it really gives you a heads up of what's going down underneath the top. For the week, we were 50-50, 5 up, 6 down. It's kind of like that for the whole week. Monday and Tuesday were extremely good for my portfolio. Wednesday was okay. Thursday sucked, and Friday wasn't as bad as Thursday. So I probably got up to 175% by middle of the day on Wednesday, but I ended the week still up about 150% on the year in my trading portfolio that I share here from time to time. So obviously a tough week for many in the market when you see this much red. When you go out and you look at the week, 2 and 9, so for the week, it was a tough market overall. Now, during the day, it'll be real time. And then the 1 day would be yesterday, but this is Sunday, so the last trading day is Friday. So it's not today, so that shows up under 1. Now, that'll change come Monday morning. So at the end of the day on Friday, or Tuesday morning in this case, I see that financials, materials, and energy were the top groups. Now, if you look here, and this is something you could reproduce end of day in HGSI using relative strength breaking and the tool that I never use, which is the raking module. And you could get an idea that financials have been stealthily getting stronger, and over the last month, they've been one of the strongest groups out there. And at the same time, some of the strength, healthcare and information technology, have been getting weaker and weaker and weaker. There's market rotation here. So that's something that might be useful. Now, it turns out this is a great top-down tool without all the bells and whistles of HGSI. So let's say that I'm interested in financials and materials. I could highlight both those boxes and hit the heart, and then that will highlight the entire row. Then if I hit those gears, I'm going to jump and open up this picture down here. And then I've sorted it by industry strength. I've got 144 possible industries. And it gives me a sense of what are the industry groups in these sectors that are leading the market. Life and health insurance. Well, that's one that we always, no, we don't usually see that. Chemicals are up. And look at the regional banks and diversified banks. Their charts have not really moved much yet. Stealthily, they're moving up off their bottom. But look how they've changed over the last couple of months. How many banks do you own? Even steel, that was a surprise to me. So let's highlight 1, 2, 3, 4, 5, 6, 7. Hit the heart, hit the peers tool. And what popped out on that was a list of stocks. And then I used a tool that Sagar has that pulls the best up to the top. And it found the stock, which is Customer Bancorp. So I picked Customer Bancorp to work up. Now, the edge is limited to the 1,500 stocks in the S&P 1500. Vital, which is this program, will actually go into Metastock, Thomson Reuters, and go through their database, and you could have multiple countries if you wanted them. So my stock universe is its industry, and this tells you that I put in QBN here, and then it built a list of its comparators. It tells me what industry and sector. I knew that already. Its price. Obviously, I'm not going to tell you to go out and buy a stock that has 100. Where's their volume? 88,000 a day. It's too light of a stock for me to tell you to go buy. But I think it tells us about the industry. This pie tells me that 97% of the stocks in its peers were up on Friday in a bad tape. That tells you there's a change coming on. This light blue undervaluation tells me the stock is very undervalued and it's a candidate for a short squeeze. Like many of the financials, its earnings quality is hurt, penalizing it. You can see the last quarter it had 63% earnings growth, 42% a quarter ago, and 2 quarters ago, 45%. So it stubbed its toes right there. So you look at the revenue growth is strong. It's in a strong group. Now, I can now hit this button here, and it will look at the fundamentals in all of these. And then I usually hit the 3 stars up here, and the best come to the top. And even looking at the bigger universe, this QB comes to the top again. I'm not sure I can buy a stock that's this thin, but it is something to think about. Now, this I thought was also important. Hard to see, so I'm just going to tell you what I see. This is the group performance report that I do in HGSI, and it gives me a sense of how I did compared to the market. Now, let me be very clear. This may have no reflection to how my portfolio does. Everything is treated as a long. It doesn't include the influence of options. There's no influence of puts or spreads. It just takes the names. But it gives me a sense if my world is winning or not. So this was a bad week. I told you I took some heat at the end of the week, and I was down 3.4%. 41 winners, 11 losers. Now that sucks. I'm not proud of it. But I have to ask, how did I compare to my peers? Well, my peers are the IBD 50. It was down a little bit more, 3.59. My peers might be the Market Smith 250. All right. Or not my peer might be the S&P 500. I don't buy those, but it's a landmark. It was down 2.31. So it just tells me that growth outperformed and that I underperformed. Now let's look at my shorts from last week. So I picked 15 shorts. All 15 of them were down an average of 5.42%. That mitigated some of my loss because I bought some of those shorts. So it's easy to pick shorts when the market rolls over. It's hard for me to pick shorts when the market's going higher. And I use it as much as a signal, as a place to go fishing. Now, how about Edge Rater? Love this thing. This is the warehouse view. So I save a snapshot of the market from the on my computer database of HGSI every weekend. Then I could go back and do back testing. Well, the warehouse view allows me to look at something very important. In HGSI, Ian's world, E stands for earnings per share rank, just like in IBD. It ranges from 0 to 99. RS stands for relative strength rank, 0 to 99. Group rank, 0 to 99. So if a stock has the highest EPS rank, the highest relative strength, and the highest group rank, it has a score of 297. The lowest stock has a score of 1. As we go further to right in every one of these graphs, that parameter is stronger, 90th percentile versus 0. ERG is combining the 3 of them together, 297 down to 1. Now, in this gray line here, this denotes how many stocks are in that particular bucket. Well, there are very few stocks in the last 2 or 3 or the highest 2 or 3 sections. So I don't count the first 3 and the last 3 pieces. So I start here and I run to here. And what do you see? Growth got hammered, where bottom fishers or bottom dwellers, the laggards were flat. Growth was down as much as 5 to 10%. Over here, the highest earnings per share ranked stocks had the biggest decline. The highest relative strength stocks, the biggest decline. Some of the stocks with no relative strength actually do well, but they were down this week as well. Group rank, the better group rank, the worse you did. Now, interestingly, since last week was very similar, 2 weeks ago was all growth, those stocks that were distributing let me go back. Those stocks that were accumulating on last week actually outperformed this week, but they were the bottom fishers. So we have some rotation here, or is it worse? How about new highs? I have Mr. Bob Meager wrote me a quick scan so I could take and set dates on new highs. So I started with my universe of stocks that I would trade at $5 and 250,000. It's about 2,700 stocks, of which almost a quarter of them had new highs since August 1st. Of those highs, as of Friday, 92 are still up for the past 3 months, though 83% of those leaders were down on the week, 78% were down on Friday, 52% are now more than 10% off their highs, 12% were down more than 10% in the last 5 days, and these were leaders. And these stocks that all hit new highs in the recent past, 24% of them were down at least 3% on Friday. Leaders have been taken out to the shed and shot. Speaking of leaders, and then going back to the question, breakdown or buying opportunity? These are the extended fangs. I call them the canaries. Who taught me the canaries? Birthday boy, Ian Woodward, back in 2013. We know that Priceline is called booking. It's already impacted on the chart. So this is the extended list that we use. We've added, so you got Facebook, Apple, Netflix, and Google, or Facebook, Amazon. We got Apple, we got Booking, and we got Baidu. And you could see Tuesday we set an all-time high and reversed. Wednesday was a rough day, and then a big gap down Thursday and Friday. Now look at that candle. Sitting on the 17-day moving average, actually closed above it. Big bottoming tail. So that 18% breakdown in 4 trading days, does this signal a top in the market? It might. It might. Or is it a nice place for a bounce? It might do that too. So I think there's some question. I look forward to hear what my buddies will tell me on Monday. Now, of course, I get people, everybody wants to take credit for this one. This was published on Friday. And I'm wondering about this. Let me start on the right. In fact, let me show you what I'm talking in real world. These are the E-mini futures. And I don't know if I can go all the way back to 2009. I don't know how much data I put in here. Come on. Oh, man, this is slow. I apologize for the pain. Yes, stop. Okay. All right, stop. Awesome, perfect. This is the market coming down in 2008, 2009. The red arrows are John Person sell signals. The green are buy. Imagine if you'd follow those signals. There's some whipsawing, but for the most part, every time the market had a hard sell-off, you would have been short or out of the market. And the buys were very short-lasted. Maybe there's a message there. In a falling market, the bounces are short and the further drops are long. Notice this is called the Commitment of Traders Report. So this is for commodities. I appreciate that my interpretation is likely different than what you've learned. This is how I use it, and it's an amalgamation of what I picked up from John Person and others. There are 3 different measurements here on this line, the COT line. The red, as I understand it, are professionals. It might be banks that have to hedge something. If they went all in long or if they sold something, they may have bought something to back it up in case to avoid losses. If I am a oil producer and I think the price of oil is going down, I'm going to buy an option. That looks like I'm going short by buying a put. All I'm really doing is I'm locking in my price. So I'm both long and short, so I'm neutral. If I'm growing wheat and I think the price of wheat is hit the peak of the year and I'm not ready to take my wheat to market, I'll buy a put. So I'll buy what looks like a short position, but what I'm doing is I'm locking in my price. So I ignore the red line. The blue line is, I've been taught, these blue bars are the hedge funds, the money managers, the smart money, the ones that know more than we do. And I've been around long enough, they know more than we do. And in yellow, those are us, the small specks. So 2008 or 2009, what are we doing the whole way down in the E-minis? We're buying. Then what happens right before we get to the bottom of the year, bottom of the market? And I don't think this is a coincidence, folks. We can't take it anymore. We go short. Who's buying those, selling us those shares? Who's long? The hedge funds, the money managers. Who's right? Well, we were short for the first year, if we being the small specs, as the market moved up. We go to where we are today, and give me a second to get there. I must have, I know on one of these I was putting in 30 years worth of data. This might be the one, and that's why it's so slow. So it ebbs and flows. But for the most part, they're a lot smarter than us. So who drove this market up to its peaks? That's right, we did. What were the hedge funds doing? They were still short, and they remain short. Now everybody's short except the banks are buying, I guess. Again, it's to hedge something. So at least we're not all net long right now in the E-minis. So I want you to remember this picture, because watch this one. And I could not figure it out for the life of me. Now I'm smarter. Why on earth does it look like the professional speculators, the hedge funds and money managers are so net long NASDAQ futures? We're neutral. Total different than the E-minis. I think I know why, and this is why. This came out on Friday. SoftBank identified as the NASDAQ whale that bought billions in stock options, betting on higher prices for the biggest name in tech. So, first of all, they were brilliant because they bought off the bottom. Second thing is what happens when they decide to sell and take profits. I think we now know why we had divergence favoring the large cap tech. A case for bonds. I can't do this justice. And I always try and call out my sources. If I was anybody who listens to me, I would go and look these guys up. Chris and Kathy Shavako Capital Management. They have a blog. They have weekly free videos, and they have Twitter, and they have a money management service. These people are geniuses, and they do such a great job of laying out the evidence. You notice the question mark. They don't tell you what's going to happen. They give you the evidence, and it's a 30-minute every Friday. Put it into your YouTube and watch it. This week, they talked about periods of time when bonds outperformed the stock market. And if you think about it, if bonds are going to do the same as the stock market, wouldn't I like to have a bond portfolio because it will take out the volatility with the election? So why would we be thinking bonds? Here is a ratio chart, easy to do in stock charts, comparing the spider to the TLT, the 20-year treasuries. This is an important horizontal support and resistance line. We broke through it earlier this year, and now we're struggling at it. Okay. I could draw another line right here that we're sitting on, trying to get back above. If we fail at this point and come back down, that means bonds are favored over stocks. Here is a Q. Again, we're trying to get back up to this trend line. But every time we reverse from these trend lines, it's bonds favored over stocks. So are we going into a time where, as we saw in 2016, bonds, much better performance than stocks at the same time? And again, we saw this earlier this year. Bonds outperforming stocks. I remember in the heat of 2009 and 2008 seeing data that showed over a long period of time the performance of the stock market and the bond market, with you including dividend yield, actually came close together. I think there are periods of times that you want to be in bonds, and I've been waiting to move some money into the bonds, and I think that time is close. There's a second reason why I'm going to do this, and if anybody has access to Piper Sandler market research and you want to pay me gratitude for all the work that I do here for free, they put out something called the investor, the perfect investor, the independent investor. It is a great monthly report. It's been so long since I've seen one, I can't remember the name of it. But if you have access to the research, I would appreciate it if you could drop me a line to hgsidoc@gmail.com, and maybe I could trade you some of my indicators for it. On the other hand, I'm going to move $1 million into Piper because they said I had to do that to get the report for free. So I've got $1 million sitting there to go into bonds, but I haven't done it yet. Maybe it's time. News and earnings, not a big news week. You can see here jobless claims. So any week's got significant because of the employment situation. CPI, PPI. So it is a busy week. It's not Fed speak. It's not Fed minutes. It's not monthly unemployment. But it's a busy enough week. And you know what? Look over on the right. You've got Slack, Coupa, Lululemon, Restoration Hardware, Zscaler. Let me tell you about Restoration Hardware. I own some. I got to decide what to do going into earnings. I went there today because I wanted to see what was going on. They built this gigantic store in West Palm, not Palm Beach, West Palm. They charge $8 to park to go shopping. They have an expensive restaurant. It was packed today, both the store and the restaurant. So maybe that's a good sign for Restoration Hardware earnings. And my wife was wearing Lululemon, so maybe it was good for them too. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Market thoughts. 2 weeks ago, I anticipated 3 potential scenarios. Number 1, market goes to new highs. I've not been a big believer of that, but it continued through Wednesday. Number 2, the leaders would roll over and catch up with the laggards. We're there. Well, that's what we started on Thursday and Friday. And 3, the markets roll over together. I still think that's possible. As of this moment, we moved into scenario number 2. The market started this week, but look at some of the monthly charts on some of these tech leaders. No shocker, the Tesla and Apple runs into splits and the Zoom blowout response to earnings led to this reversal midweek. You look at the top line percentages fallen, not a big difference, but it was much more painful on Thursday and Friday and really nice on Monday and Tuesday. The VIX spiked 34%. Options give you a 10-to-1 leverage. 3-to-1 options or 3-to-1 or 2-to-1 instruments might make that leverage 20 to 30%. Most of the time I buy those, they expire worthless. Today I paid for most of those worthless ones from the last several years or this week. The last time the S&P 500 was at this level was in August. So that great last 2 weeks of August and first week of September gone. You can see performance year to date. The NASDAQ and S&P remain positive. The Dow dipped back into negative after this week. And the Russell has still made a great comeback. I took some heat this week, but finished the week still up 150% year to date. I put protection on my major positions, Apple, Microsoft, Facebook, and Amazon. I loaded up Wednesday with QQQ puts, TQQ shorts, VXX and UVXY lottery calls. And I will use any holiday bounce as an opportunity to unload remaining long positions in my trading account. My guess is that the easy money has been made this year, and it may be time to go less offensive into the election. Cash is a position. With the Feds committed to low rates for some time, bonds might become more attractive. Once again, HGSI Doc and Friends Labor Day special tomorrow, 10 a.m. to 2 p.m. I already got a couple hundred people registered, and I will Look at the number at 8 o'clock tomorrow morning, and I'll expand my room for that number. I suspect there'll be people that don't show up, so there should be room. If you get locked out, sorry, that means a lot of people came in at the end. Special offers leased from HGSI for new users, and there it is, tinyurl.com, HGSI Doc, Labor Day 2020. All right, I know I'm at 45 minutes, but this week it's all about the market. I'm not going to show you hundreds of great stocks to go buy. I got a couple I like. And then perhaps a way that I'm going to be thinking about the market. And I'll look at Amazon and Quidel. So let's start with, I just want to show you what happened on the futures with some of the things I do in TradeStation. Here's the E-minis. We've been talking for a month about the bearish divergence in the MACD. Again, higher highs, and lower highs on the MACD histogram. This new peak barely was positive on the histogram. We had a John Person sell signal come in Thursday as the market had its first shot down, and it went down further on Friday. As you could see, a bottoming tail has formed. We shifted from a green, which means you could buy or hold, to a red where you shouldn't be going long, you should be shorting or holding. We went to blue, which is neutral on the weekly, still green on the monthly. The later time frames are still in a buy signal. We are in the middle of our envelope here, so it's not a lot of damage. And notice, I'm going to stop it and put the other high jump in. So notice how the high jump crossed above the 95%. In fact, it hit 100% on Wednesday, and Thursday it closed at 61%. It just gives you an idea of how much excess on this market was eliminated in those 2 days. We are no longer extended on the S&P 500. Weekly Bongo is still green. If I look at the Dow futures, looks a lot like the S&P, so no reason to spend any time. Didn't quite get above 95. If I look at the Russell futures, you can see the highs are way back here to the left. Again, a sell signal came in, middle of the range there. Never made it to the high jump bar. But if we look at the NASDAQ futures, this was with a leader, we broke down all the way to the bottom of the envelope and bounced it. So we ended up back in the middle. If we look at my high jump and you look at on Wednesday, we're at 100%. Tuesday, we're 100%. So we clearly gave the sell signal right in there. Here's Wednesday, 100%. And we dropped down to 63 on Thursday as some of these excesses were worked off. One could argue that that's a bullish chart because you went down the bottom envelope and bounced. I'll wait and see what we do this coming week. The dollar, as I mentioned before, firmed, and you could see it had a buy signal come in on Wednesday. Never got down here to 100% negative on the high jump. Got down to minus 80-ish. All right. Let's go into HGSI. I always start with the market analysis charts. First button, Major Markets Plus. I hit Warehouse View. I have 28. I added the IBD Momentum and the IBD Innovator ETF, as well as the FANGS ETF. I then start with a top-down view just so I could show you. I've got my 28, and this is being ranked by performance, price, and volume. One day the greatest, some at 5 days, and some at 3 weeks. So what do I notice here? First thing I notice is that Treasury ProShares TBF, transports, the dollar, silver, commodities, and high-yield bonds are the best. Utilities. That's not good for my portfolio because I'm a growth stock guy. Down at the bottom, oil, bonds, NASDAQ, mid-caps, Russell, IBD 50, Dow Industrial, breakouts. So clearly a bad week for those that do growth. Let's take a look at some of these. Now I'm going to move this up some just for charting purposes. Find that S&P 500. Here it is, number 9. Take me a second to set this up. I've been looking at monthly charts as you'll see, I've got already had set it up here. So I want to make this, both of these will be and daily. All right, I think that's what I want. All right, let's make the top go away for a second. So here is your S&P 500. Massive move off the bottom. Here is the prior high. We have come back. We pierced it, but right now we have successfully tested the prior high. That to me is a line in the sand. We have come off the top. We had a red candle high at the high jump here. We all knew this market was going to roll over. It's just further evidence of it. We had a pocket pivot, a person sell signal came in on Friday, and a kahuna to the downside. Are we done going down? How can one say that? This is a massive uptrend. Have we broke it? I'm not even sure we've broken the uptrend here. I think this is important. What's my three-road scenario? High, low, and middle scenario? Well, my high road is that we bounced and we go up to new highs. My low road is we're not done going down. And then my middle road is going to be where we continue to bounce around till we declare. My guess is we're going to go more the middle road. Maybe we get a holiday bounce this week. But I still think that this downtrend is a concern. And I'm not ready to say it's not going to happen. So the S&P's had a big move. It's retesting. This is a line in the sand here for me. We had a gap off of it, and now we're coming back to retest it. If we can hold above that, I would consider that to be extremely bullish. Look at the Dow Jones Industrial Average. Sound like a broken record, except it's not at its prior highs. Also big uptrend. New sell signal came in, pull back. Mobile breakout from a squeeze to the downside. But is it broken? Not yet. It's still above the 50 and the 200. It might get broken. If I look at the Russell, pulled down and bounced off of the 200-day moving average. If this was a stock, wouldn't you want to buy it if it moved up from here? Again, is it broken? Maybe. It's not dead. We'll see what happens this week. And then the NASDAQ. Here was its prior highs. I'm not even drawing that here. Pulled back to the 50-day moving average and bounced with a big bottoming tail. Doesn't that look like it wants to go higher this week? I'm surprised at myself for being somewhat bullish short term, and maybe that's the key word, short term, because a lot of these look like they're at good bounce places. Hence, I lightened up a little bit of my short stuff on Friday, but boy, I'm ready to put it back. If I look at the US dollar, sideways, up off the last 4 days off the bottom. If I look at the VIX, we already talked about the VIX spike we saw. Not much of a spike. It was if you were heavy loaded in the right options. And we gave back some of that on Friday, which I find surprising. I find that very surprising. If I look at gold and silver with the dollar perking up, best you could hope for gold pulling back into the 50. Is this going to be setting up a buy point? I'm going to watch, because if that was a stock, I love it when they pull into the 50 and bounce. I need the bounce. Gold miners, similarly, knife below the 50 but stopped above it with a doji. And if I look at silver, less bad than the others. Now, so you an IBDer at heart. Well, you had a bad week. Here's the IBD 50 breakdown. Look at where it stopped on the 50-day moving average. Is that shocking? Is that coincidental? How many of these have hit the 50 or the 17 and stopped falling? Or is that where support is? We'll see what it does on Monday. The IBD breakout opportunities, well, we know breakout stopped working, broke down, spinning, I don't know if it counts as a doji yet. There's still too much body, but maybe there's enough length. But that's an indecision bar. Well, that's a negative bar that ended with some indecision. Let me put it that way. And oh yeah, I love the fangs. Fangs got hammered, but look at this. It's kind of a hammer on the 17-day moving average with a big bottoming tail. Isn't that what you might expect if the stock was about to do this? I told you in the first 5 minutes, I got some bullish and I got some bearish thoughts. Now look at the fang. Things don't go up in a straight shot. Look at the weekly, look at the monthly. That's not how things are supposed to go. That was a blow off and we topped. Question is, how long have we topped for? If we go to industry groups, as you can see, I've got 175. What you should not be surprised to see is that, hold on one second. Sorry about that. My son was giving me a baseball update. I don't care about sports this year. So 175 groups. If I go the 2-day force up, you'll see I'm down to 20 positive. If I go 2-day force down, I should have a ton. Nope, I've got 2. Why? Because they've been down more than 2 days. This only looks at the last 2 days. If I look at the 5-day down, I've got a lot of groups to the downside. I've got 72 with only about 20, if I remember correctly, 19 to the upside. Let's look at what's to the upside. And this is where I made a comment earlier about junk. Maybe they're not junk. Maybe it's where everybody wants to be. Cruise lines. That doesn't look like the FANG chart. All right, we got a fry pan bottom. We're breaking out. We're going to the moon. Maybe. But really? I mean, every time we've run up, we've come back down. We know they're not going out of business. They got some refinancing. But do you want to put your savings into cruise lines? Somebody will at the right time. They're going to make me look stupid. Maybe it's the right time. I know TG gets excited. His tool picks up these quick moves very well. His Moxie trading. I've been around too long. I'll be happy when it breaks above that 200 and tests. I'd rather give up the next 10 to make the next 70 and avoid being stuck in limbo. Norwegian looks like Carnival. Royal Caribbean, all right, truth is here. It's at the 200, rising 8, 17, and 50. It's getting pinched. If it breaks out here, retests, and goes higher, I'm going to be in Royal Caribbean. And I'll say I was wrong. I should have bought it back here. I just need to see that because it's done this before and failed and failed and failed. And it didn't really fail, just came back, and now it's going higher. That's not where I want to put my money, at least not my growth money, maybe investment, long-term money. Airlines, same story. At some point, these are going to be great buy. Here's American, here's Delta. Yeah, it's going to be a $60 stock. But when? When? The monthly charts on the FANGs were the other way. Takes a long time for this to reverse. I'll believe it when I go on planes and they're packed again. Or airlines, airports that actually have people in it. I did take a position last week because I was tired of listening to TG saying how great they were. And one of these times he's going to be wrong and I'm going to look stupid. So I bought some Alaska Airlines. I actually made $4,000 on it so far. So I'm not unhappy. But same thing, I got to see it get above that 200. Renewable energy companies. I don't know anything about Vivo Power. It looks like a Robinhood stock to me. It had on Friday 16 million shares. And if I go back to this day, less than a month ago, it had 59,000. So there's news. Somebody's going crazy. Maybe it's the best thing ever. If I had it at 2 and it went to 15, I'd agree. But to buy it here is risky. And look, this traveled from 8 up to 15 and back down to 11 in one day. How do you trade that? Unless you're a day trader, and I'm not a day trader. That's the only one in the group there. Go down to the next one. Commercial vehicles. Workhorse, I actually own this one. I bought it last week. It whipsaws, but I'll show you a lot of patterns. Here you got a high base. You could almost argue a cup, a handle. Now I just need a breakout. But until proven otherwise, it's still in a box. It's got to break out of that box. Ran down to the 50 here. Mobile breakup from a squeeze kahuna. It's worth the flyer. It's also high close doji, but I don't count that because it's in an uptrend. High close dojis mean more to me in a downtrend. Navistar, you know, this is what you want to see. Break out above the 200 and then give you a new base and break out again. 2 kahunas in the last 4 days. Positive John Person signal out of a squeeze. That looks great. I just don't know how far it's going to go. It's back up to its old highs. Banks starting to stir, but you look at the charts. Okay, here's why I said they're stealthily going up. If you had bought this stock here, we'll call it at the end of this positive day, and you had it into the close, that didn't work right. Hold on a second. You'd be up 23% in 79 days. That's a pretty good response considering everything. So maybe I should get off and say banks are great. Look, they look better to me than airlines and cruise ships. They're in business. There's people there. They're not going anywhere. None of them, well, most of the big ones aren't talking about going under. Maybe it's time for some M&A. They won't really do well till yields go up. But I think banks look good. So you got, pick your poison, U.S. Bancorp. They all look the same. Citizens Financial, Huntington Bancorp, Trust Financial. You can just go and do KRE for all I care and buy the regional bank ETF. It pays a small dividend, 3.5%, and it doesn't have any individual names. And yeah, look at it on the monthly charts. It's come up way off the bottom, 30%. Now, we could try and remember what was the one that I saw in Sagar's tool. And I'm going to cheat and go look at it in my other program. I guess I'm going to try, but it's not working. So, all right. That monitors, was it no B, no, but let me go back. I think it was QB. The difference between this, remember I said he uses fundamental analysis? Same chart pattern, not enough volume. Look at the fundamentals here. If this stock really brings in this type of earnings, it's a lot more than a $13 stock. It trades at a multiple of 5. I don't know. Maybe it's worth a flyer. Maybe if Sagar sees this, he can talk about it tomorrow. Now, back to the story here. I'm getting tired. You're getting tired. Listen, entertainment content. Okay, I guess I'm watching a lot of TV, so maybe something like Discovery makes sense. But boy, these are down in their pattern. Oh yeah, let's buy movie theaters. They're starting to open up again. Why? But this is what happens when you have junk off the bottom weeks. You start getting the laggards come to the top. Energy, they all look the same too. They're all right. Footnote, don't look at this. They just came out of bankruptcy. I don't think it's the same shares that you had a $2 share and now it's 24. It's either new stock or they had a massive reverse split. George, if you're watching this, please check Whiting Petroleum. I think they changed their stock and that this is no longer accurate. Concho Resources, Hess, the Index, Apache. Arch Coal is the only one that looks buyable to me. It's got clear momentum. Too close to the 200 for me to chase it. Doesn't make, well, it's got, in 2 quarters, it's got some interesting growth. Pays a small dividend. And by the way, Arch Coal is a coal stock. Specialty apparel. Now we're talking. Burlington broke out above its 200. Earnings are out. It makes money, although it's got negative earnings per share growth. This has been a leader for some time. Come winter, people are buying their coats. Vera Bradley, here's that pattern where I would have ignored it. Broke above the 200, kind of tested, and is moving again. I'd have no problem looking at Vera Bradley. ANF, same pattern. Love it. Just broke above the 200. Again, are these great? Are these outstanding? Are these the ya cha-cha-chas? No. So far, the best of what I've showed you, though. So Duluth Holdings also looked really good. Look how it broke above and just spaced and then just started breaking out a month ago. I don't think it's run too far. It used to be a much more expensive stock. Look at the earnings per share growth coming in. I like Duluth there. Department stores, really? Macy's? Not with my money. Kohl's, maybe Amazon buys one of these companies. Look like airlines and casinos. Yeah, they had a positive move on Friday, so they made it to the list. And then life insurance, that made it to the list. There's some interesting patterns here. Look a lot like regional banks, but you have a mobile breakup from a squeeze, a kahuna, pocket pivot, makes money, pays a 4% dividend. Una Provident Corp, about to break above the 200, mobile breakup from a squeeze, pocket pivot, kahuna, a new John Person buy signal, and it makes money, not much growth, pays a 5.7% dividend. Aflac, tired of their duck, pays 2.9%. These look interesting. The dividends are attractive. MetLife, 4.6. Hard to believe these old companies are going out of business. Let's just look at diversified banks. You know, the only one there that I was interested in was Bank of America. You know, it's going to break above that 200 eventually. Is it going to do it this time? Why buy until it does? Had a mobile breakup from a squeeze, John Person indicator, pocket pivots, and kahunas. I'm in preservation mode. I'm not chasing things until they break above resistance. JP Morgan looks the same. Citigroup looks the same. Wells Fargo, much below the 200. And lastly, just look at steel producers because U.S. Steel made some of the lists. I don't know. I can't convince myself. The thing's been going sideways for the whole year. Someday maybe. I can't imagine it does well if Trump loses. Look at the losses. It's under demand. Interesting. All right. At this point in the show, I usually talk about my buy list and my short list. Since I was 100% on my shorts last week, let me just put out the stocks that I was going to monitor for my short list. These were some of the shorts, mid-cap spider. You know, a breakdown from here, it's going to be interesting. Look at Shopify, broke down below the 50, did not retake it on Friday. Trade Desk, I hate shorting this stock. It's been such a winner. Same thing, failed here. Two kahunas to the downside or low, pocket pivot to the downside. John Person sell signal, mobile breakdown from a squeeze. So here's my list of potential shorts for the weekend. Again, I use them as much as a warning signal as shorting them, although there's several there that I want to short. Let's look at my buy list. You can always stop it and write them down if you want to hold me to it. Educational purposes only, remember. Many of the stocks that I like, we've already talked about. Let me call out a couple of them. JD.com, Chinese internet play, pullback in a flag here, bounced off the 17, closed near the high of the day. Any stock that was up over 1% on Friday has me looking at it. So JD.com looks interesting, good earnings per share growth. Darling International, high base, mobile breakup from a squeeze, new John indicator, kahuna, and a breakout, at least coming up. Next earnings are not to November. Great earnings per share growth coming in. It's not a sexy business, but I like the picture. Hancock and Whitney is another one of the banks. Mobile breaker from a squeeze, John Person buy. Notice how the stock's gone flat. Notice the positive convergence in the PMC and a kahuna. It does have enough volume. You want to take a flyer on a healthcare stock, Biomerica, don't know anything about it. It's sitting on its 200-day moving average. It had a green candle low, signaled my low jump bar, and had a kahuna and bounced. You could put your stop right beneath it. Don't know anything about it. I'm not vouching for it. Nada, nothing. It's just, I love the pattern, but I wouldn't spend much more. Buy 100 shares so you can watch it and laugh at how bad it's going to do. Greenbrier and Trinity are train companies. Mobile breakout from a squeeze. New John Person indicator a couple days back. Pocket pivot and kahuna. In a bad market, this thing looks like it wants to break out. And then lastly, I told you workhorse on semiconductor. Another uptrend base breakout opportunity. Mobile breakout from a squeeze, had a PSI reversal already, sitting on the 50, pocket pivot, kahuna. And what I like a lot about this is I can put my stop right below the 50, maybe even above the 50, so I'm not risking the farm. Now I want to finish with a tale of two stocks. I'm going to start with Amazon. This is for my favorite neighbor, Kathy. What am I going to do with Amazon? And how do I manage this stock? So Amazon, if I was a candlestick guy, I am a candlestick guy, I might look at this pattern here and, well, this pattern from here up to here, you got an evening star pattern. You gapped up with a doji, gapped down with a long red bar. That's a very bearish candlestick pattern. So that's bothersome. All right. We had a big pullback. How big of a pullback did we have? If we go to the maximum down, we were down 12% in these three bars, or two trading days. That's a pretty gigantic pullback. But then again, look at where we're sitting. We pull back to the 50, and we have a doji on the 17. So what do I think is going to happen with Amazon? I have no idea. I'm being honest, and I own a bunch of it. I could tell you that I have every one of my shares covered with a $3,300 put, which is in the money now. And I've sold 3,500 and 3,600 calls to pay for the 3,300 put. So I really don't care what Amazon does. As long as it doesn't go up to 3,600, I'll be fine. But as I look at this, I would kind of put a box on Amazon. And my box is here. And I know that all these people up here who thought they were buying the world's greatest company on a breakout, these guys are losing money. And this is an expensive stock. When you lose money on Amazon, you're losing a lot of money. Get back here. So there might be some buying or some selling pressure in there. So are we going to go into this box and bounce around for a while before we break out? I think that's very possible, and that's a pretty wide range, okay? Is it possible that we're just going to break out the bottom of this box and go down to that 200? It is, hence why I've got my puts on. But we're bulls. It's got to go up, right? So here's Amazon. I'm going to stop this for 1 second. Just about done. Here's Quidel. All right, we'll start off with, here is sort of an evening star. It's also a person low closed doji, a bearish signal, which is a variation on an evening star, probably a better variation. And I could have been looking at this day just as I looked at the Amazon, and I could have said to you, it's simple. Put a box assume there's overhead supply in this box and buy it when it breaks out. I wouldn't just buy it because it's at support. Boy, this is great support on that 50-day moving average. It's held 1, 2, 3, 4, 5, 6 times. I need to buy Quiddell on that 50. 7 times, 8 times. Oops. Oops. What do we call support once the price has broken down below support? Call it resistance. So, guess what we have? We have another box here, don't we? I think this is a dangerous stock, and I'm going to have to take a picture of this and save it because we're sitting right here on Amazon, right there. It could go sideways. It could go up. It could go straight down. Let's not forget that it can go down. On that note, I'll say goodbye. Have a great day. Hope to see you tomorrow. And one last time for the one person probably left still watching this video after I've talked for an hour and 15 minutes. Here it is, Monday, tomorrow, 10 a.m. to 2 p.m. HGSI Doc and Friends, Sagar, Dr. K, John Person, myself. Special offer from HGSI, George, in commemoration of Ian's birthday and Labor Day. And we'll see you tomorrow. Bye, everybody. Have a great night.